Are you considering taking a loan from your Vanguard 401k plan? Understanding how to access funds from your 401k is crucial, especially when you're in a financial bind. A 401k loan allows you to borrow from yourself, providing a unique advantage over traditional loans from banks or credit cards. While borrowing from your 401k can save you on interest payments, it's important to remember that this option isn't free of cost or consequences. So, what exactly is a 401k loan? A 401k loan is essentially a loan you take from your own retirement savings account. It functions like a standard loan. You will pay origination fees and interest, but you are borrowing money from your own retirement fund. According to Vanguard, 78% of 401k plans allow participants to take out loans, and about 13% of plan participants currently have an outstanding 401k loan. With a Vanguard administered 401k, you can borrow up to one-half the value of your account to a maximum of $50,000. This is in contrast to IRAs, from which the IRS prohibits loans. Some companies also prohibit 401k loans from their own 401k plans, unlike the Vanguard 401k. When considering a Vanguard 401k loan, it's important to note that the interest rate is typically set at the prime rate plus 1 or 2 percentage points. It means that while the interest rate is generally lower than what you might find with other types of loans, it's still a cost to consider. The interest you pay goes back into your 401k account, which helps offset the loan of potential growth while the funds are borrowed. However, the overall impact on your retirement savings depends on how quickly you can repay the loan and restore those funds to continue growing. Vanguard 401k loans are also subject to the same general rules as other 401k loans, including the maximum borrowing limit of $50,000 or 50% of your vested balance. You might consider taking a 401k loan if you need money and want a lower interest rate than what traditional lenders offer. The interest rates on 401k loans are typically based on the prime rate, with an additional percentage point or two added on. This rate may still be lower than what you'd find at a bank, making it an attractive option if your credit score isn't strong enough to secure a low-rate loan elsewhere. Another benefit of 401k loan is that you're paying interest back to yourself rather than to a bank or credit card company. This means that while you are still on the hook for interest payments, the money is being returned to your retirement account, helping to offset the cost of borrowing. Additionally, 401k loans generally don't require a credit check, which can be a significant advantage if you have a low credit score. However, there are also reasons to avoid taking a 401k loan. If you anticipate leaving your job soon, taking out a loan from your 401k might not be a good idea. If you leave your employer, you may be required to repay the loan in full by the tax deadline for the following year, which is typically 15th April. If you're unable to repay the loan by then, the outstanding balance is treated as an early withdrawal, subjecting you to taxes and a potential 10% penalty. Another consideration is the impact on your retirement savings. While you do pay back the loan with interest, the money you borrow from your 401k is no longer compounding and growing in the market. This lost opportunity for growth can significantly affect your retirement nest egg, especially if the loan is not repaid quickly. Regarding how much you can borrow from your 401k, the general rule is that you can borrow the greater of $10,000 or 50% of your vested account balance up to a maximum of $50,000. The funds you can borrow are limited to the balance in your current employer's 401k plan, not the collective balance of all your retirement accounts. If needed, you may be able to roll over funds from other accounts into your current 401k to increase the amount available for borrowing. The repayment terms for a 401k loan usually span up to 5 years, with at least quarterly repayments required. If you are using the loan to purchase a primary residence, your employer may allow a longer repayment period. It's essential to review your plan's specific terms and consider making more frequent repayments or borrowing for a shorter time to minimize the opportunity costs of having money out of your retirement account. It's also crucial to remember that if you leave your job while repaying a 401k loan, your company determines when the loan must be repaid. While some companies allow repayment until the tax deadline, you must ensure that the loan is repaid by then to avoid taxes or an early withdrawal penalty. If you've decided that a 401k loan is the right move for you, here are the steps to follow. First, talk to your employer about the loan options available in your 401k plan. Next, learn about the specific terms, including how much you can borrow, the interest rate, and the repayment schedule. Then fill out the necessary paperwork, which may be done online depending on your plan administrator. Once approved, you'll receive the loan funds directly in your bank account or as a check. Remember to make regular payments on the loan and, if possible, continue making regular retirement contributions to prevent a pause in your savings. Ultimately, whether a 401k loan is the right choice for you depends on your financial situation. For some, especially those with poor credit, a 401k loan can be a useful tool to avoid high interest debt. However, it's important to be aware of the risks, including the potential for the loan to be converted into an early withdrawal if you can't repay it or leave your job early. Additionally, by taking a 401k loan, you might miss out on significant investment gains and compound interest, which can have a lasting impact on your retirement savings. Before taking a loan from your 401k, consider exploring other options like emergency funds, taxable investment accounts, low-cost loans from personal lenders, or even 0% APR credit cards. While a 401k loan can be a viable option in certain circumstances, it's not always the best choice for everyone. Make sure to evaluate all your options carefully and consult with a financial advisor if needed to ensure you're making the best decision for your long-term financial health.